Creating wealth is a dream shared by many. The answer lies in diversified investments. Diversification spreads your investments across different asset classes. This reduces risk and leads to more stable returns. Think of it as not putting all your eggs in one basket. The goal is to build a balanced portfolio. Wealth creation is about growing your money steadily over time. Understanding asset classes is crucial. The main types are stocks, bonds, cash, and alternative investments. Stocks offer high returns but come with higher risk. Bonds are safer but offer lower returns. Cash investments are the safest but with the lowest returns. Alternative investments provide diversification but are often complex and risky. Combining these creates a balanced portfolio. Investing in multiple asset classes helps manage risk. Within each asset class, diversification is equally important. Take stocks, for example. Investing in different sectors like technology, healthcare, and finance spreads risk. Geographic diversification is also crucial. Domestic stocks are important, but international stocks add another layer of diversity. Different economies move differently. Bonds also offer diversification opportunities. Government bonds are typically safer than corporate bonds. Mixing these can balance safety and higher returns. Even within cash investments, diversification matters. A mix of savings accounts, CDs, and money market funds can provide liquidity and safety. This can be useful during market downturns. Fixed income investments are essential for stability. They offer regular income and lower risk. Bonds are the most common type. They pay interest over time and return the principal at maturity. Government bonds are considered the safest. Corporate bonds offer higher returns but come with more risk. Municipal bonds offer tax advantages. Fixed income investments also include preferred stocks and fixed annuities. Preferred stocks offer fixed dividends. Fixed annuities provide guaranteed payouts. Diversification within fixed income investments is important. Different bonds react differently to interest rate changes. Fixed income investments play a crucial role in a well-rounded portfolio. ETFs and mutual funds are excellent tools for diversification. They pool money from many investors to buy a variety of securities. This automatically diversifies your investments. One fund can hold hundreds of different stocks or bonds. ETFs are usually passively managed, tracking an index with lower fees. Both ETFs and mutual funds simplify diversification. Real estate is a valuable addition to any portfolio. It offers tangible assets and potential for appreciation. Rental properties can provide steady income. Real estate investment trusts, or REITs, are an alternative. They allow you to invest in real estate without owning property. They pay out most of their income as dividends. This adds another layer of diversification. Real estate can enhance your portfolio's performance and stability. Regular portfolio rebalancing is crucial. Over time, your investments will grow at different rates. This can shift your portfolio's balance. Rebalancing brings it back to your desired allocation. This maintains your risk level and investment strategy. Rebalancing involves selling overperforming assets and buying underperforming ones. It might seem counterintuitive, but it ensures you buy low and sell high. Without rebalancing, your portfolio can become too risky or too conservative. Rebalancing should be done periodically. This could be annually or semi-annually. The key is to have a plan and stick to it. Regular rebalancing is a disciplined approach to maintaining a diversified portfolio. Consistent investing is the foundation of wealth creation. It's not about timing the market, it's about time in the market. Regular contributions to your investments build wealth over time. Dollar cost averaging is a strategy that involves investing a fixed amount regularly. This reduces the impact of market volatility. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this can lower your average cost per share. Dollar cost averaging takes emotion out of investing. It prevents you from trying to time the market. This steady approach builds wealth gradually and reduces risk. Consistent investing and dollar cost averaging are keys to long-term wealth creation.